I thought I couldn't get a loan while self-employed until I found this. Traditional banks are set up to serve W-2 employees, not entrepreneurs, and that's why so many self-employed buyers get denied unnecessarily. If you're self-employed and applying the normal way, you could waste months getting rejected, miss out on the market, or worse, think you're unqualified when you're not, making you give up on your dream of home ownership. I'm Andrew Russell, owner and founder of RCG Mortgage, three-peat winner of Broker of the Year, top originator across the country, and I've worked with thousands of entrepreneurs, business owners, and contractors to put them in the right mortgage products and set them up for success for real estate riches. So let me ask you, you got a pool? Your friends have a pool? Everyone loves swimming pools, right? Well, I have a swimming pool. And the swimming pool, I mean, if you know anything about pools nowadays, there's gunite, which is super cool, a little bit weird on the feet, but super gorgeous. Like there's these new liner versions, right? Pools, nowadays you want something decent. Maybe you have Phelps come over and show you how to freestyle. So some of the bigger ones, I'm a bigger guy, I like big stuff. They're very expensive, 100,000, 150,000. Nowadays it's probably with inflation, $200,000 or more. But turns out the owner of this pool company was struggling, believe it or not, to get a mortgage. And I don't know if you know, year over year expenses on a pool, it's so brutal. It's never just the pool, it's opening it, it's closing it. You know, the who's what's it's got struck by lightning and it's another $12,000. It's super brutal. You never know if they're being honest. But when he came over to help kind of assess the situation for the year, turns out he was applying to purchase a super cool house. It was like this real cool property on the water. It was amazing. He was upgrading. He was going to sell his current house, bring his family to a bigger house on the water. But turns out he's getting denied, and which was crazy because this is what I do for a living, and I was one of his better clients. He didn't realize he thought I was in real estate, or some kind of investments. He didn't realize I was in mortgage. So we kind of talked through it, and just like I thought, his company was killing it. I was one of the people that was helping his revenue, jack through the roof. But they were showing, pretty much a break even for the year, just like all business owners. So if this resonates with you, whoever's listening, business owners, entrepreneurs, self-employed, he specifically was making way into this. It might even been 8 figures in yearly revenue. And he was showing a $60,000 W-2 and a break even for the business. So when he went to apply for this gorgeous, multi-million-dollar property, he was showing the bank, hey, last year I make $5,000 a month, which is $60,000 for the year, and nothing for the business. So $5,000 a month, very quick math. He had great credit, I'm sure. And, I don't remember at the time, but I'm pretty sure it was like a 740-ish. Let's call it a 740 between friends. He qualified with no debt for a $2,500 mortgage payment. $2,500 a month, didn't even pay the taxes, let alone the insurance, let alone the millions of mortgage. So of course he was getting declined. So I said, look, great news for you. There are these new mortgage programs called non-QM, self-employed programs, right? All under the non-QM product suite, where it's based off of your business bank statements. He was kind of in shock. Thank God he didn't fall in my pool because that would have been an insurance claim. But nonetheless, he offered out his 12 months bank statements because these programs require 12 months of the business bank statements. No tax returns needed, which is super cool for these programs. And think about it. If he's making 8 figures, $1 million a month in revenue, he was 50% owner of the business. That $1 million a month, now all of a sudden it's $500,000 a month. He's half owner. From there, that $500,000, we give him credit for half of that for income. That's $250,000 a month of income. So think about how crazy that is. $5,000 a month of income versus what? $250,000 a month of income. 50x, I think, his purchasing power. So it just had to do, he was going into the wrong program. Self-employed business owners, entrepreneurs with a couple of year more track history should typically never be looking to get mortgage programs. You have to show your tax returns, show your actual income in the old way. The old way, that's what it's based off of. And under IRS tax code, as long as you're taking normal, legal, allowable write-offs, you're never going to qualify for a house. Whereas these new programs, what we're talking about now, QM loans based on business bank statements, potentially a P&L, which we'll talk about, potentially the 1099s, which is different, but we'll talk about that as well. It's a 12-month review. Get the last 12 months of this gentleman's bank statements. Look at all the deposits. It's about $1 million a month, which net out to 8 figures a year in revenue. That $1 million a month, what percent do you own of your business? He's half. So that $1 million turns half of that's $500,000 a month. And then from that, the lender will give you half of that credit of half of that amount for income, which is $250,000 a month. So technically, I know it sounds crazy, but if this person wanted, they could have got a $120,000 mortgage if they had no other debt. I truly can't imagine $120,000 a month in cash for a mortgage. His mortgage was somewhere around $20,000, which is still pretty absurd. But It just shows you it was super simple to qualify. Sometimes people are just going into the wrong mortgage. So because of that conversation of, whatever's happening with my pool, it's just a typical conversation we have with self-employed clients. Hey, what are you looking to purchase? I think in his case, it was a $2.5 million house. Awesome. What are you looking to put down? His case, 20%. Cake, great down payment. So it's a $2 million mortgage. All right, what is the taxes look like on the property? It was something like, $36,000 or $3,000 a month. Great. What was insurance? Call it $500 a month or $6,000 for the year, something like that. So the mortgage payment would have been about $14,000 for a $2 million mortgage based on a rate around 7% with a 7.5% APR, very loose, plus another $3,000, $17,000-ish with inclusive of taxes, add another 500 or so. It's about 17,500 for his mortgage. He had no shot. He was pretty much dead right out of the gate from a qualification perspective doing the full documentation route. But this way, he qualified super simple. But of course, all the haters always say, Andrew, you always oversimplify everything, broski. Why does it always seem so simple? Well, listen, some people, when you watch them salsa dance, it flows, it's gorgeous. It just looks like they know what to do. Some people, they have two right feet. It's the same concept. I've worked with so many people, and this specific mortgage, it's a keep it simple mortgage. You run their credit, and you make sure they have a good credit profile and also a good score. And typically you want a 660, 680, maybe even a 700 or higher for best case pricing for a big loan size with 20% down. You look at 12 months of their bank statements, look at the deposits, you look for any type of inconsistencies or volatility, but it's just that simple, right? As long as you know what you're doing, this is a more streamlined program for self-employed clients. And it's actually, that's right, easier than if you did the full doc tax return, a million questions for your CPA. And of course, Andrew, I'm sure he's your pool guy. You took care of him and got him a great rate because these programs probably are ripoffs, right? No, just to reiterate what I've said in many of these videos, when these programs first came out, sure, it was risky. Market didn't know if they were going to perform, meaning pay on time. And if the going rate at the time was 3.5%, there was a time the rate was 3.5% on a 30-year fixed vanilla mortgage. Maybe these were 5.5 or 6 or 6.5 or 7%. Then what happened is these programs became somewhat flat and similar to the going rate. And of course, unfortunately, the pandemic and COVID happened. Not only did the rate go really high, they came off the shelf. And these programs came back, recently. And again, it started, if the going rate was, at the time, it was brutal, 7.5% on a vanilla 30-year fix. These programs are 9.5%, maybe 10% from a 30-year fixed rate perspective. And again, just like before, the clients are paying them on time. So there's a big appetite for them in the secondary market. So now, not only are these interest rates typically the same or very close, maybe a quarter higher in rate, we have seen instances where they're actually better than if you did the typical vanilla full doc route where you would always assume the interest rate is better. So short answer, no, the rate is not something we're getting ripped off. These are just amazing programs because guess what? The equity positions are higher. People putting 20, 25% down versus some other mortgages. So because of that, the secondary environment is willing to reward the clients with a better interest rate. And of course, hey, Andrew, although he's probably your buddy, the pool guy, it probably took months and months. I've read horror stories about how long it takes for exotic mortgages to close. No, that is not the case. Just because it's more exotic in your opinion doesn't mean that it can't be a streamlined program. Just to give you a timeline, on a Monday, if we got the sales contract, the purchase contract for the buy, if after we got the purchase contract, we finished the application, say the client e-signed with us, meaning, hey, we're willing to move forward. At that time, we order the appraisal, the title, and of course, we send the loan to the underwriting team for approval. So on that Monday, by Wednesday, Thursday, we probably know from the lender what they want from the client as we await the appraisal results for valuation perspective and the title report to make sure that title is all good to change over to our buyer. So by the following week, we should have the appraisal results back, the title results back, and also the requirements from the lender from the client. So by the following week again, now you're a little over 2 weeks into it, you could be clear to close, which just means ready to close. Now, of course, this is somewhat of a perfect world example. Things happen. Sometimes clients, they don't drop what they're doing to send good old Andrew and RCG their bank statements or, a couple letters or maybe a letter regarding a judgment, or you never know. But if you have client cooperation and you work with the right lending team, a 2 to 3 week close, it should be the norm. It shouldn't be the anomaly, right? So as you can see, just because the loan comes across exotic doesn't mean that it has to be, tedious or something where you'll pull your hair out. These type of mortgages, if you have it down to a science, you close them efficiently and expeditiously. All right, guys, so I'm going to show you an illustration of exactly the client that I was referencing, the gentleman who owned the amazing pool company, where he originally went from mortgage perspective, why it went wrong, what loan we put him in, and then 2 other options outside of that depending on some of the circumstance of self-employed, your business, there's a lot of variables of what other options are that exist and why those are cool as well. Before we do, make sure you go in the description, click the link. We have our self-employed cheat sheet for all types of self-employed mortgages. My team spent a lot of time on this, guys. Make sure it's free, no catch, no snags. I'm not gonna text you 24/7 to try to sell you some weird product late in the night. I promise you're not gonna get in trouble with your wife or with your husband. So go in your description, click the link, download the free guide. It's awesome, guys. We made it just for you, and it gives a nice, keep it simple illustration about everything that we've referenced here. All right, so as in the example of the gentleman that's purchasing, he wanted to buy a $2.5 million house. So the optics, everyone says, oh, I'll put 20% down. Perfect. 20% is $500K. So that left him with a $2 million mortgage. Now, let's go like this. Typically, first line of defense is over here. Let's say we'll do a full doc. What does that mean? In mortgage land, right? So many terms in mortgage world. It means you're showing your income. So full doc, we're going to call this a jumbo. So anything over, a little over $1 million is considered in our world jumbo. So if you remember, I said taxes were $36,000 for the year. Insurance was at least $6,000 for the year. So you figure that's about $3K a month for the taxes, $500 a month for insurance. All right, so because he owned a business, they filed business returns called 1120S, which is S Corp business returns. So they went into the local lender, of course, and it's 2025, right? So they asked for 2024 and 2023. So each year, he got a $60,000 W-2, which over here we'll say from an income perspective for qualification, we have $5,000 a month of usable income. And then outside of that, we had basically a net zero. So if you've ever seen an 1120S, just think there's a lot of rows. And those rows are, first, you have your revenue, which he was making about $12 million for yearly revenue, which is a lot, $1 million a month. How could he ever not qualify for this property? Well, turns out he had a high staff, which was a big expense. So a lot of other stuff, some legal stuff, and that kind of netted after his $60,000 and his other partner took a W-2. They somehow found a way to write a lot of stuff. They had a lot of equipment, right? You can write off some of the equipment every year, year over year, to net zero. So $5,000 a month of income. Let's assume, like I said, about a 740 credit score, and I write ND, means no debt. Not much debt on his credit profile, which is cool. He put himself in a position where he was able to pay for his kids' college with cash, cars in cash. He was doing very well. But when you try to get money for a mortgage, they look at different stuff. So that $5,000 a month, it lends itself out to a $2,500 a month mortgage payment. So $3,000 for taxes. He doesn't even qualify on paper for the taxes with a full doc loan. So this showed you clear as day why Plan A didn't work. So now we're going to go to Plan B, which, believe it or not, was better than Plan A. Just didn't know about it. So now we're going to do, in the non-QM suite, the bank statement program. So bank statement program is simple. We don't have to worry about jumbo guidelines, which are a little more stringent. We don't have to worry about 1120s or tax returns. None of that's needed. So this magic number here will come down to $12 million in yearly revenue. So $12 million again in yearly revenue, which is about $1 million a month in revenue. Now from there, we say, hey, what percentage you own of the business? Turns out he owns 50%. So half of $1 million is now, it whittles down to $500,000 a month. Now from there, how do they calculate that $500,000 what we give you credit for income? So the easiest rule for a bank statement program client is you literally just take half. 50% expense factor is assumed. So now $250,000 a month is the income that they got credit for. It's literally that simple, right? Imagine over here on this loan, $5,000 a month, $2,500 a month mortgage payment. Assuming no debt, this could have been up to a $125,000 mortgage payment. I don't even know what that looks like. It's a wild number, guys, but it's never going to be, this type of client would never want that high of a mortgage, believe it or not. So if you do the math over here, you just keep it real simple, around a 7%. This is very loose, 7% rate on a 30-year fix, 7.5% APR. this would be about $14,000 a month. Again, it's very loose, guys. It just gives you an illustration because it's very close. Plus another $3,000 plus another $500, so another $3,500. So that's a $17,000, as we said, $500 a month mortgage payment. That's $17,500. If we're giving him credit for $250,000 of income, is like a what? A 4%, something like, no, 7% debt to income ratio, something wild. So on paper, more than qualified in the bank statement program, right? So the $250,000 a month of usable income, the mortgage payment is $17,500 a month. Couldn't have been an easier approval. And it just goes to show, some people just don't realize, the typical vanilla is, hey, I bank with ABC, right? So let me walk into them, talk to one of their mortgage professionals, and say, hey, I want to buy a really nice, expensive house. This is what my down payment is. How could I ever not qualify? Maybe that person does what a lot of loan officers do and issue a pre-qualification, looking at no documentation, just because they don't realize how much issues can come up on a tax return to affect the borrower and qualification. And then what happens? Downstream, they send in their 2 years tax returns. They don't qualify. Everybody's upset. But it was as simple as putting them in the right program based on what they do for a living, which is self-employed business owner, based on how much revenue they generate, which is $1 million a month, whittling it down to $250,000 a month of income, or so a $17,500 mortgage payment, including taxes and insurance, is doable all day long. But now that, we're heroes, life is good. The client was able to move into their house within 30 days. Now, two other examples, just real simple, so you guys are in the know, in case this either didn't work or it wasn't appropriate because maybe this person was a consultant. The first one is a P&L program. Now, a P&L program typically has a little higher of a rate from a bank statement program, but the benefit of a P&L program is a profit and loss. If you think of a profit and loss, you just think of your revenue, your expenses, and your profit. Now, it's typically over the last 12 months. So as an example, if right now it's September of 2025, you would get a profit and loss from, say, 9/1/24 to 8/31. We're going to look at the revenue. We're going to look at the expenses. And then we're going to look at the net profit. Now, this is something that is prepared and put on a CPA letterhead. This is not something that's audited. This is just their QuickBooks or their rough estimation of what this looks like. There are some lenders that even allow a borrower prepared. So borrower says, okay, this was my revenue, this was my expense over the last 12 months, this is my net profit based on those numbers. So as you can see, it's even more of a streamlined program for qualification. Now, why would we do this? Yes, it's a little bit less paperwork than bank statements, but if this rate's a little bit higher, why would we do this? So say it's a seasonal business. Now, for whatever reason, this pool company was not seasonal. They did a lot of stuff over the other months where I guess if you paid in full for future pool projects, and if you know how it is in New York, March could have snow, April might even have snow, and then maybe they break ground on some of the stuff in April or May. But in January, they're not breaking ground for a pool if it's snowing out, but they actually were collecting monies all throughout the year for prepaid. I guess there was some kind of incentive if you prepay for the pool. So they didn't need a P&L program. And why would you need it? Say the income's volatile. So there are businesses that are based on season. So say, for instance, you collect money May, June, July, and then you collect money October, November, and the other 6, 7-ish months, you don't collect any revenue, but you still kill it. You still make 8 figures throughout the year. An underwriter might see your last 12 months business bank statements and say, hey, your income's unstable. I don't know how much you're going to make. There are months you make 0, so it doesn't work. But on a profit and loss, even if the income over the last 12 months was that 12 million number, and even if your expenses were, 10 million over the last 12 months, it still leaves you with a $2 million profit, which is about $167,000 a month of income. And even if you're half owner of the business, still 83-ish of income, because you get half of that. What they don't see on a profit and loss is, oh my God, over the last 12 months, maybe 6 or 7 of the months were 0. And that's the benefit of the profit and loss, because if you over the last 12 months make a certain amount of money, when it comes in, it's kind of inconsequential. If the business is open, it's stable, and it's consistent, meaning year over year, you're actually doing your thing, and there's no worries about declining income and various things. profit and loss makes sense for more right? Seasonal businesses versus something a little bit more stable. So a profit and loss program is amazing, another version of a non-QM bank statement program, but not using the bank statements, just using a pure profit and loss. But it really only makes sense, again, if your income is somewhat volatile, it is consistent over the years, but month over month, if it's a little more volatile, a P&L may be better suited for you. What's the catch? Rate might be a little bit higher, way less paperwork, and frankly, if you qualify with this program and nothing else, and you say beggars can't be choosers, but he who has the money makes the rules. It's definitely a little bit more risky just getting a P&L versus actual bank statements, but these programs do exist. You can buy a $2.5 million house, putting 20% down with a great 30-year fixed interest rate, and just show a profit and loss and not have to show any bank statements. That actually exists. Now the last one, just on an aside, is a 1099 program. Now some people are contractors, consultants, and they get a 1099, they might file a Schedule C as a sole proprietor, and on their Schedule C, if they were to do a full doc loan, even if they were making $600,000 in 1099s, 1099s, guys, are not like W-2s and mortgage. It's almost considered cash. So you'll look at a Schedule C, consider them self-employed, these type of clients, and not ask for the 1099. Look at the expenses, and I've seen people write off $550,000, so that $600,000 whittles down to $50,000 for the year, and the same thing, you just don't qualify. So the benefit of the 1099 program is that we go off of the 1099 minus only 10% haircut. So that's $600,000 a year. Say that's what you made in 24, $600,000 in 23. So 10% off the top is $540. So we'll give you credit for yearly income of $540,000, which is what, like a little over $40,000 a month, just using the 1099. So instead of the $4,000 a month, which was based on a $50,000 yearly, you get credit for $40,000 or more a month because it's based off of the full 1099 minus a 10% haircut for expenses. That's what the lenders do. Now, of course, if it's April forward, they're going to want to see your year-to-date, which could be a snafu. Maybe you're a realtor, and maybe you're a little bit slower. Maybe your date's a little bit down. That could be problematic here. You might want to, do one of the programs above. That might be a little bit easier. But 1099 programs are outstanding because typically over the years, 1099s were not used. It was the Schedule C, typically, which showed a lot of expenses, and the net was never high enough. Now we can use that actual 1099 number, making sure year over year you're consistent or growing, and then your year-to-date is in line with the past. Then, if you're a consultant, the program's a home run. But this is just another example of a non-QM product, specifically 1099, is how they check income, so you don't have to do these full doc programs and set yourself up for failure. All right, guys, so if this pool owner's story resonates with you, make sure you watch our next video, choosing the right mortgage for you. If you're a business owner, choosing the right mortgage is super important, guys. We're going to dive into all the different income modes, all the different products that are available, going through them, seeing which one makes the most sense for you. So make sure you click and watch. I'm a business owner. How do I choose the right mortgage? Watch this video, guys. Gives you the best breakdown.